after our 2-week hiatus, guys. Talking about more exciting mortgage broker things. Jim Montrym here, your famous Florida mortgage broker instructor, bringing you some hot new topics of the mortgage industry. And again, maybe some of you out there new that haven't watched this before. It's pretty simple. At the end of this, guys, I'll ask you a quick quiz question. All you have to do is respond to my email. And at the end of the year, I'm going to give away about 10, 15, 20 CE classes, free continuing ed. So, hey, I've been getting great response on this, guys. Thank you. Those of you that are sending me around, I get a lot of positive comments. That's the best compliment I can give. And in addition, when you share me with somebody, I'll take $1 off your CE at the end of the year. How many you send to those people? I keep track of it. And you get some credit that way, too. And maybe I'll draw your name. So I will ask that question at the end. Okay, here's the deal for today, guys. We got about 3 or 4 quick topics I'm going to give you here, all right? The first one I want to talk to you about is the new Tiller RESPA rule. I mean, this is obviously going to be the one that everybody's sweating bullets about right now. And frankly, guys, it's really not that big of a deal, in my opinion. I think it's a change in how the industry conducts itself. But overall, is it going to be a major change? No, it's going to be a little rough going through it. But I think once we get through it, we'll be glad we did. And I think it'll probably be better for those of us out there that do this honestly, that treat our clients fairly. It discourages some of the bad actors, from doing these things. So overall, it's good. So one thing I'll just point out, guys, this is probably worth noting. Now, these new forms that are coming out as of August 1, we're going to, again, get rid of the GFE and come out with a loan estimate. The key thing on that, guys, is, again, you're still going to have to provide it to the consumer within 3 business days of getting all 6 required bits of information, just as we have in the past. Now, if there's any changes, guys, to that, any changes, all right, the bottom line is, and you say it's a significant change circumstance, the rule is going to be is this. You're going to have to redisclose and wait 4 business days, okay, after that, okay, before you can basically go further with the transaction. So that's one change that's coming. Now, the tolerances, guys, again, are all the same thing, guys. It's an 1/8 of 1% on the closing disclosure. If it's a fixed rate loan, 1/8 of 1%, up or down, you got to redisclose and wait 4 days. If it's an ARM type product, the tolerance gets a little bit higher. It's 1/4 of 1%, all right? Now, the finance charge, the amount of money they're paying to borrow that money, that has stayed the same, $100. And again, guys, if you think about what's going to happen here come August, again, that final closing disclosure, you're going to have to give to them 3 business days prior to closing, filled out, ready. So again, I think it's just a change in the way business is done. I've already said this. I think you guys are going to go from being not only mortgage guys, but also doing a lot of the title stuff. But it should cut down. And I think really the other part of this, guys, that I've been hearing in the industry is you've got to extend those rate locks. 30-day rate locks probably are not going to happen as we get closer. I think you should be shooting for a 45 to 60-day lock-in window as these changes come in, and there's going to be a lot of chaos. You don't want to miss those deadlines. So that's something I'll throw out there. Now, also another thing that's probably worth noting, guys, pretty simple thing. Now, all these rules, guys, these new forms, the closing disclosure, the loan estimate, they only affect financed transactions. So in other words, if you're doing a cash transaction, which I know mortgage brokers, we don't want to hear that, Jim. We don't do cash transactions. But if it is a cash transaction, you can still use the old GFE and HUD-1. So again, worth noting, these forms only affect financed transactions, which is us, okay? Let's talk about this one. Now, here's a change that's going to come up this year. It hasn't happened yet, but it is going to happen. And this is, again, the CFPB, Consumer Financial Protection Bureau, kind of twisting some arms there in D.C. with the credit bureaus. And what they're going to come out with this year, they're saying, okay, right now we know we can give people their credit score when they apply. We have to give them their credit score when they're turned down. Now, a lot of times on some of these deals, you have to send people to counseling, all right? We're talking, again, first-time home buyers, negative AM loans, Section 32, reverse loans, someone who has lost a home FHA in the last year, trying to get another home now, they have to go to counseling. The new change coming up with this on these nonprofit counseling companies, they will be allowed to give the consumer, when they go to counseling, their credit score. Now, They will not be allowed to give them their credit report, the actual credit report, but the score, Experian, Equifax, and TransUnion has agreed. Now, further on top of that, Experian, one of the other credit bureaus, has actually come out and said they're going to be in favor of giving the borrower the actual credit report. So again, that is a change that's going to be phased in probably by the end of this year. Look for that whenever you send somebody to counseling. Let's talk a little bit more about this counseling. Another issue that I think is worth noting. Right now, you know, it typically works if someone has to go to counseling, either A, you go to HUD's website or CFPB's, and they'll give them basically 20 companies that provide this counseling. Now, some of the issues that have been raised with the regulators as far as this counseling. Now, again, obviously, most times when someone is purchasing a home, you're going to give them counseling agencies, 10 within the geographic area that they're in, and 10 that are national counselors. Now, they've run into situations where the person really, their address they were using wasn't necessarily the property address. You understand? So they're giving them counseling companies that may or may not be in that area, okay, that are local to them. So what they've basically done is said, okay, if someone basically is outside the area, they live outside the United States, for example, right, foreign national, then you can use the zip code of where the subject property is, okay? Makes perfect sense, okay? Also, it says there, too, if the applicant has a P.O. box, that's their address, is a P.O. box, again, you're going to use the address of where the property is located, okay? And then again, obviously, you could also use the zip code, again, within the surrounding areas for those counselors. So again, there are those situations where not necessarily is the address you have for the borrower the actual property address they plan to occupy, but they have to go through the counseling, all right? So common sense, once and again, a blind squirrel finds an acorn, that being the government. Yes, very good. Guys, on the discipline front, which again, none of us like to hear, all of you are honest mortgage brokers. You don't break the law, don't break the rule. No brokers do that, Jim. I'm one of, when the mortgage melted down, Jim, I'm not one of those mortgage brokers that put people in crappy loans. I'm a good guy. Everybody was a good guy. Well, anyways, I'm going to call this segment A Bad Day for New Day. I don't know those of you that know these guys are. They're on TV. New Day Financial. They specialize in veterans VA lending. Well, the boys at VA and New Day got themselves in a pickle recently. They were found, what they were doing was they had an in-house school. They were providing the test questions to people, which you're not supposed to do in my line of work. It's a 20-hour educational course. They were doing that. And also, here's the one they really did that was bad. They were having people take the self-paced online continuing ed, and it wasn't really them. And you say, Jim, how do the regulators find out about this? It's real simple. Somebody leaves the company pissed off and wants to get even, okay? I've said that over and over to you guys over the years of my classes. It's generally not the government that finds out. It's somebody who works for the company who feels they got shafted who decides to turn you in. Now, what did this cost New Day for this little transgression? Ready for this? $5.8 million fine, number one. Number two, the CEO had to resign, and they had to agree to an independent auditor, all right? Somebody coming into the mortgage company, making sure that the people are doing it. Now, one thing I didn't see in there that's kind of interesting, did anybody lose their license? You know, I mean, is $5.8 million, is that really a cost of business? Or is that a deterrent to doing that? I'm going to be going to D.C., guys, in the next week or so, speaking to the general counsel at CFPB and also at the Conference of State Bank Supervisors. I'll have more on that issue when I get back. I'll be talking to you about that. Okay, finally, guys, one last thing, real quick one, all right? This is a legislation that was passed by the House of Representatives, but it probably isn't going to happen, but you want to be aware of this, I think, okay? What it was, it's called the Mortgage Choice Act. Okay, it was passed by the House of Representatives in the last week, and it really kind of stinks. And what it is it's basically saying we all know about the 3% QM rule, qualified mortgage, and again, basically anything that goes inside that 3%. If you're a lender and you own the title company, you're a builder and you own your own title company, a realtor, the past ruling, CFPB's rule was those costs are included in the 3% cap, if basically the company owns that title company, appraisal, survey, any service in the loan. Well, the title insurance companies got on this one real quick and said, and the banks, the lenders as well, and the bank said, you know what, we're going to have legislation written where if we own the title company, the bank does, all right, which is going to be the wave of the future, guys. I don't know if you're aware of this, but the CFPB and the government has pretty much come out and said to the lenders, you're responsible for everything in that transaction. They already got the appraisals, about the appraisal management companies. Well, this is the next evolution. They're basically saying, hey, lender, when there's a screw up in a loan, we want to go after the deepest pockets, you. So going down the line, I think you're going to be aware of this, guys. The lenders are going to dictate the closing agents, okay? In the past, it's generally been the seller because they purchased the title insurance for the buyer. But you're going to see come this year, it's going to be more driven by lenders picking the closing agent. So they've already went to Congress and said, hey, when we own the title company, those charges, title services, are not included in the 3%. For anybody else, they would be. Well, here's one of those rare moments, my friends, boys and girls, where I'm going to say something good about Obama. So listen carefully. He's going to veto the legislation. They have promised to do so. About the only time I've ever agreed with anything he's done. All right, finally, guys, I told you I'd wrap this up with a quiz question, the free CE question. Here it is, guys. I want you to tell me the next team Tim Tebow will be cut from. Okay, send it to me, Broker School 2. Win some free CE. I'll see you in a couple weeks. Thanks. Bye.